While the world focused on equity indices, CPI prints, and rate cut speculation, the real event happened inside reinforced vaults and clearing ledgers in New York and London. Screens showed liquidity. Metal told a different story. On paper, silver was abundant, rehypothecated, arbitraged, margined, and rolled forward. In physical form, it was finite, slow to move, and increasingly spoken for. This was not a price story, it was a balance sheet story. As America's $34 trillion debt load expanded, the system responded the only way it could, by manufacturing liquidity through paper claims. Futures, ETFs, unallocated accounts, each one a promise, each one dependent on confidence, settlement, and rule enforcement. But physical silver does not respond to confidence. It responds to removal. What the public saw was continuity. Contracts cleared, ETFs tracked spot, settlement reports printed on schedule. What actually happened was removal. Physical silver began leaving the system quietly, not through panic buying, but through fulfillment. Long-standing requests were executed. Industrial contracts were honored. Private allocations were transferred out of exchange-controlled vaults. No alarms were triggered, because none were designed to trigger. On the screen, silver remained abundant. In storage, it became specific. Bars were earmarked, lots were reassigned. Metal that had supported multiple paper claims now supported one. The market did not react, because the market did not see it. The mechanism was simple and asymmetrical. A, holders of paper silver were given optionality, roll forward or stand for delivery. B, a minority chose delivery, often for non-speculative reasons. C, each delivery removed metal permanently from the circulating pool. D, paper issuance continued unchanged. The arbitrage incentive broke down at the margin. Normally, price differences between futures and physical invite convergence. But convergence requires metal mobility and confidence in replacement. As physical supply thinned, replacing delivered bars required either new mine output or reallocation from other obligations. Neither moved quickly. Margin pressure increased indirectly, not through price spikes, but through balance sheet awareness. Each delivered contract increased exposure for remaining shorts. Each withdrawal reduced buffer capacity. This functioned like a vacuum. Air does not rush out evenly. Pressure builds silently until resistance gives way. Liquidity was not destroyed, it was removed. The response was administrative. Inventory reports became more frequent, then less detailed. Delivery notices were processed slower, then bundled. Exchanges did not halt trading. They narrowed pathways. This mirrors earlier phases of structural stress. In 1980, rule changes followed concentration. In 2008, collateral definitions shifted before freezes. The pattern is consistent. When physical or cash exits, rules adapt to slow it. Each step increased stress. Slower delivery increased counterparty uncertainty. Uncertainty increased the value of holding physical. That increased removal. The latter ascended without noise. Force majeure remained unused, but increasingly plausible. The signals remained external to price. Premiums for immediate delivery diverged sharply from futures quotes. Some dealers stopped quoting size altogether, others quoted, but with conditions. Inventory categories told the story. Eligible metal rose. Registered metal declined. The distinction mattered. One was metal that existed. The other was metal promised. Industrial buyers extended lead times, not because demand fell, because supply certainty did. On the screen, silver still traded. On the dock, silver was already spoken for. The hidden event was not a run, it was a drain. And drains, once established, do not reverse without force. What the public saw was a functioning market under mild stress. Bid-ask spreads widened slightly. Volumes rotated from one contract month to another. Analysts described it as positioning. What actually failed was conversion. The system still allowed paper silver to trade freely, but its ability to translate claims into metal began to degrade. Settlement remained legal. It became conditional. Nothing snapped. The gears slipped. Participants who had assumed delivery was a formality began to discover it was a process, slow, discretionary, and increasingly negotiable. This failure followed a rigid chain. A, physical withdrawals reduced available deliverable inventory. B, reduced inventory increased exposure for short positions. C, exposure raised internal margin and collateral scrutiny. D, scrutiny discouraged new delivery commitments. Arbitrage relies on certainty, not price certainty, but settlement certainty. Once delivery timelines extend, the arbitrage incentive collapses. The trade no longer closes cleanly. Capital becomes trapped between paper profit and physical uncertainty. Margin pressure intensified quietly, not through exchange hikes, but through internal risk controls. Banks required more collateral against the same nominal exposure. Funds reduced size to avoid forced delivery risk. This created a bottleneck. Like traffic entering a tunnel where exits are restricted, flow slows even if the entrance remains open. Liquidity appears present, but throughput collapses. Paper claims continued to circulate. Physical metal did not. The escalation was incremental. First, margin requirements were adjusted at the edges. Then, delivery procedures were streamlined. These changes reduced friction for the system, not for claim holders. Historically, this phase mirrors the pre-freeze conditions of 2008, when funding markets still cleared but required increasingly favorable terms. It also echoes the 2022 nickel halt, where price was allowed to move until settlement threatened balance sheets. Each intervention increased system stress. Margin hikes reduced participation. Reduced participation increased concentration. Concentration increased fragility. Force majeure was still absent. But contingency planning was active. The real-world indicators grew harder to ignore. Some dealers refused to guarantee delivery dates. Others required full prepayment. Premiums decoupled entirely from futures prices. Inventory data showed stagnation, not recovery, not replenishment. Industrial users reported procurement delays, not shortages, delays. The difference mattered. Delays signal stress before failure. The screen price remained composed. The physical system did not. By this stage, silver had split into two markets sharing a name but not a function. One traded claims, the other rationed metal. The mechanism had failed. The price simply hadn't admitted it yet. What the public saw was professionalism. Statements about orderly markets, assurances that settlement systems were robust. What actually occurred was internal retreat. Risk committees met more frequently. Exposure limits were revised. Balance sheets were stress-tested against scenarios that had previously been considered remote. No one announced panic. Panic does not announce itself. On the screen, silver continued to trade. Behind it, institutions began preparing for non-performance. The visible market projected calm. The institutional layer began to pull back. The mechanism here was behavioral but predictable. A, the delivery uncertainty increased counterparty risk. B, counterparty risk triggered internal capital charges. C, capital charges reduced willingness to intermediate. D, reduced intermediation tightened liquidity further. Arbitrage desks require confidence that trades can be closed. Once that confidence weakens, the incentive disappears regardless of price spread. The trade is no longer mispriced. It is unfinishable. Margin pressure accelerated. Not from exchanges alone, but from internal models, assuming worst-case settlement outcomes. Even stable prices required more collateral. Even low volatility demanded higher reserves. This functioned like a vacuum. Liquidity was not taken, it was withheld. Institutions exposed included bullion banks, clearing members, and funds using silver as collateral. Each faced asymmetric risk, upside capped, downside undefined. Once that asymmetry is recognized, behavior shifts immediately. The escalation became visible in procedure. Delivery notices slowed, clearing thresholds tightened, position limits were reviewed. The stage rhymes with multiple historical events. In 2008, repo desks withdrew before markets froze. In 2022, the London Metal Exchange halted trading when margin calls threatened members. The pattern is consistent. First, participation declines. Then, rule flexibility increases. Finally, continuity is preserved by intervention. Each step increases stress by signaling that normal operation is no longer assumed. Markets depend on the belief that rules will not change mid-process. And once that belief weakens, everyone acts defensively. Force majeure was still theoretical, but it was now plausible. The signals sharpened. Some institutional dealers exited physical quotes entirely. Others limited transactions to existing clients only. Inventory movements showed concentration. Metal clustered with fewer holders. Circulation slowed. Industrial demand became urgent, not louder, more insistent. Manufacturers extended contracts, stockpiled where possible, substituted where necessary. These are not speculative actions. They are defensive. On the screen, silver prices remained bounded. In reality, access to silver did not. By the end of this phase, the market was no longer unified. Institutions were no longer neutral intermediaries. They were risk managers first. And risk managers, when pressed, preserve the system, even if the market fractures. What the public saw was continuity by adjustment. Updated contract language, clarified delivery terms. What actually changed was the meaning of ownership. Paper silver still traded, but its relationship to physical metal was rewritten. Delivery was no longer assumed, it was conditional. On the screen, contracts looked the same. In practice, they behaved differently. This phase followed a familiar institutional logic. A, physical scarcity threatened settlement reliability. B, settlement risk threatened clearing stability. C, clearing stability took priority over claim integrity. D, rules were adjusted to preserve throughput. The arbitrage incentive collapsed completely. Paper and physical stopped converging because the bridge between them was no longer guaranteed. Margin pressure became structural. Even without volatility, holding paper exposure now carried policy risk. That risk could not be hedged. It could only be avoided. This created a queue. Claims continued to enter the system. But fulfillment slowed and then selectively stopped. Liquidity appeared high because trading continued. But liquidity without exit is not liquidity. It is confinement. The escalation reached its most sensitive stage. Margin requirements were standardized upward. Delivery windows were widened. Cash settlement incentives were emphasized. Each step reduced immediate stress for the system while increasing long-term stress for participants. In 1980, silver rules were changed to stop concentration. In 2008, settlement definitions expanded to prevent default. In 2022, trading was halted outright when margin cascades threatened members. The pattern is preservation over precision, not declared, but operationally present. Once rules change to prevent delivery, the market ceases to clear information. It clears risk. The real-world signals confirm the shift. Premium stopped tracking futures entirely. Some physical prices were quoted without reference to spot. Delivery delays became normalized, not apologized for. Explained. Inventory categories lost relevance. What mattered was access, not classification. Industrial users accelerated off-exchange sourcing. Sovereign buyers avoided public channels. Private vaulting increased. Because screens now reflected policy, not supply. By this point, the divergence was complete. Paper silver functioned as a financial instrument. Physical silver functioned as a scarce input. What the public saw was endurance. Trading continued. Charts updated. Prices fluctuated within familiar ranges. And what actually occurred was exhaustion. Physical silver continued to exit the system with no corresponding inflow. Vaults were not emptied dramatically. They were depleted selectively. The easiest metal moved first. The most encumbered remained. No announcement marked this phase, because the system was still functioning on paper. In reality, convertibility had ended. The final mechanism was arithmetic. Years of paper issuance created claims far exceeding deliverable supply. B. Physical removal reduced the remaining settlement base. C. Reduced base increased default sensitivity per claim. D. Default risk became systemic, even without an event. This was not caused by panic buying. It was caused by cumulative imbalance. Arbitrage was gone, liquidity was cosmetic, margin no longer mattered because settlement, not price, defined risk. This phase resembled a bottleneck closing entirely. The queue still existed. Tickets were still valid, but the exit was no longer open. Institutions were exposed asymmetrically. Losses were not immediate, but obligations were undefined. A cash settlement could satisfy contracts. It could not satisfy confidence. The system depended on continued acceptance of substitution. At this point, escalation options narrowed. Halts were possible, but destabilizing. Rule changes were possible, but already exhausted. Force majeure remained the final tool. Each option preserved the system by sacrificing certainty. Historically, this is the terminal stage seen in every liquidity failure. In 2008, it was funding. In 1980, it was concentration. In 2022, it was margin. Here, it was metal. The risk increased not because something failed, but because nothing could fix the imbalance without acknowledging it. Acknowledgement would require repricing. Repricing would reveal insolvency. So the system chose endurance. The signals were unmistakable. Physical premiums became detached from futures entirely. Delivery was negotiated, not scheduled. Inventory reporting stabilized at low levels without recovery. Industrial users secured supply privately or reduced exposure. Sovereign entities avoided public exchanges. Private vaulting replaced market participation. The screen price continued to print, but it no longer cleared supply. By this stage, silver had become a diagnostic tool, not a commodity, a measure of system stress. The drain did not stop, because nothing replaced what was removed, and systems that cannot replace critical inputs do not fail suddenly. They persist until they don't.